Welcome to this video where we talk about how to prepare a budgeted income statement. If you have also watched the video on how to prepare an operating budget, the scenario is exactly the same. It's using all the same data. So if you've seen that, this will make a lot of sense because you'll be seeing a lot of the same numbers and a lot of the same calculations. And so I just wanted you to know that there are related videos out there that will make a lot of sense if you watch them together. So here's our scenario. We've got a whole bunch of information about sales price, raw material requirements, our average labor cost and build time, expected sales units, and some variable and fixed overhead components. So all of this is going to go into our scenario to actually build a budgeted income statement. So here's what we do. First of all, we need a sales revenue piece of information because we need to calculate what our sales units times sales price is. So our expected revenue for the month of April, for example, will be the 300 sales units that we expect times the $30 selling price. So 300 times 30 equals $9,000 in revenue. So that's how we're calculating that first piece of coming up with the expected revenue dollars. Then we need to calculate a budgeted cost of goods sold based on those same sales units. But first we have to come up with a manufacturing cost per unit, and that manufacturing cost includes several different things. One is the direct materials. So in our case we have raw materials. We require 2 linear feet of raw materials at $2 per foot. So that's $4 for each unit. Our direct labor, it only takes us half an hour to build the product. So our $15 rate is actually $7.50 per unit. And then our variable manufacturing overhead that's been given to us is 40 cents. Our fixed manufacturing overhead has been given to us because that is the $8,000 divided by an expected production of 4,200, gives us $1.90. So we add all of those parts and pieces up and we come up with a grand total of $13.80. That $13.80 is multiplied by each level of sales units that we're expecting in each month. So 300 units sales in the month of April times $13.80 gives us a budgeted cost of goods sold of $4,141.43. And then you do the exact same calculation for May and for June. Our gross margin is just the difference between the sales revenue and the budgeted cost of goods sold. So for the month of April, it's $9,000 minus $4,141.43. That gives us a budgeted gross margin of $4,858.57. And then you do the same calculation for May and for June. Then we have to come up with our selling and admin expense. Part of this is variable, so we have to take that 62 cents per unit, multiply it by the budgeted sales units of 300 to come up with $186. Then we add to that the fixed selling and admin expense of $700 to come up to $886 for the month of April. Then you would do the same calculation for May and for June. Then we do the final piece, which is our budgeted net operating income. That is where we take the gross margin of $4,858.57, subtract the budgeted selling and admin costs of $886. That gives us a budgeted net operating income of $3,972.57. And then you do the exact same calculation for May and for June. This should be fairly straightforward as opposed to the operating budget. The operating budget can get a little confusing because you're handling beginning and ending inventories. But if you have any questions, please do not hesitate to leave them below. I'll be happy to get back to you and help you out. And I look forward to seeing you on the next video.